cure or prevent the tax dis-ease, especially in retirement. In this episode, we are going to address the question, what are the biggest expenses for retirees when they hang up their spurs and ride into the sunset of retirement? My name's Doug Andrew, and I've been a retirement planning specialist helping people optimize all of their assets and minimize unnecessary taxes so they don't outlive their money. And I've been doing this 45 years. I've written several books, but this is probably one of the greatest concepts that we're going to address in this episode that people don't understand, which causes many Americans to outlive their money, and I'm sure it goes across the world. Now, when we retire, and I don't like the word retire, if you've heard some of my other episodes, retire means put out of use. I don't want to be put out of use, do you? But see, in the Industrial Revolution, when they retired worn out equipment in factories, put it out of use, they decided also to retire people, put them out of use, and that's very sad because do you know that before the Industrial Revolution, people didn't retire. There was no such retirement. You basically worked in the fields as a farmer or whatever until the day you died. But all of a sudden they said, nope, we're going to retire people and we'll give you this little pension and so forth, and we'll bring in new blood that's cheaper, younger people. And so the Industrial Revolution caused these large companies to try to save money and retire people. The sad thing is that when you put yourself out of use, your life expectancy is shorter. At the time, the average person's life expectancy in America was only 7 years. If you were a government retiree, it was only 6 years. If you were a military retiree, they felt like they lost all meaning, and so the life expectancy was only 5 years. So the whole Social Security system was designed during that period to only have to pay out benefits for an average of 7 years. When people started living longer and redefining themselves in retirement, they didn't have enough money to keep paying for 20 years because now the average life expectancy for a baby boomer couple, for example, one of you will likely make it to age 96. They didn't plan on that originally. And so what are the two biggest expenses that run up when you're older that erodes away 40, 50, 60% or more of your retirement resources? We'll go through those right now. So you probably already have an idea, but one of the biggest expenses in retirement is health care costs, because we're having to spend money at that time in life when we start to have a lot of health issues. And this is why so many couples, their entire nest eggs, their entire estate sometimes gets drained dry because they need to cover the health care costs, or maybe they even have to end up into a long-term care facility. And this is what then created the long-term care industry, and to get long-term care insurance so that it doesn't wipe you out. That's pretty expensive insurance. I have my long-term care insurance incorporated into my life insurance policy because I maximum fund my life insurance. I do that because I earn a net internal rates of return of 8, 9, 10% cash on cash, but my money's in there, $1 million, $2 million, $3 million, generating tax-free income. But if I get into trouble with my health, I can access money out of that tax-free and do it much better, and I'll have a better benefit than many times when you take out long-term care insurance policies, because you're self-insuring, taking the same money you would pay an insurance company for long-term care insurance, and you're self-insuring by putting it into a life insurance contract. And even many life insurance policies, if you're diagnosed with a terminal illness, you're going to pass away likely in 2 or 3 years. If you have $1 million policy, many insurance companies will give you maybe up to half of that in a living benefit. Oh, you've got a lot of costs here. We'll give you up to $500,000 of your $1 million death benefit, because they know you have enough money in there that will pay out $1 million at the end of the day. So there are better ways oftentimes to take care of the health care costs than to feel like you've got to have this Medicare supplemental policy and this and this and this and this and this. But that's probably one of the greatest expenses. I know some retirees that tell me their prescription drugs that have been prescribed to them gobble up $1,000, $1,500, $2,000 a month out of their incomes. Or they go to the doctor and they have to have a hip replacement or knee replacements. I know several right now. I'm 67 and I've tried to keep my hips and my knees in good shape, and my therapists say you will never need knee replacements or hip replacements, I hope. But many of my friends have. The actual mobility is not the same. But they spend sometimes $100,000, $200,000, $300,000, or they have heart issues, or maybe they have cancer and they're trying to nip it in the bud. But healthcare costs go through the roof for the elderly. What's the other big expense? Taxes. So we'll talk about that next. So when we talk about the other biggest expense that erodes away people's purchasing power, besides healthcare, it's taxes. And a lot of people didn't see this one coming. I don't know, their head was in the sand and they didn't realize that it was open season. The IRS was hunting around for their tax revenue that they were planning on getting out of your hard-earned money that you contributed to an IRA or 401k, where you agreed, like most Americans, you know what, I want a tax break on the seed money. See, if you're a farmer, and you have the choice of buying your seed in the springtime, and you don't have to pay tax on what you pay for the seed. So you got more money to invest. And it will grow tax deferred. But when you go to harvest your crops in the fall of life, now you agree to pay tax. Why do people get duped into doing that? Because they're told they will likely be in a lower bracket. Folks, that is not true for most Americans. Most people are not in lower tax brackets. If you're in a lower bracket, it means you didn't save very much. Is that why you want to be in a low bracket? Because you don't have very much money? If you have a respectable retirement nest egg, most people are in as high or higher tax brackets as they ever were during their earning years, during their retirement years, even if they have less income. I've seen it across the board, from school teachers to professional attorneys and doctors. They're not in lower brackets, even if they have less income. Why are they in trouble? It's because they were going down the highway with one foot on the gas pedal, the other foot on the brake pedal, and they didn't know they were doing that. They were putting money into a tax-deferred account thinking they would be in a lower bracket, but they assured themselves they would be in a lower bracket with the other foot on the brake pedal by killing their deductions. They're paying off their mortgage, so in retirement, they don't have that deduction anymore. If they're business owners, a doctor, a surgeon, they don't have those deductions anymore. The kids are gone, so you can't deduct them anymore, or if they move back home, sorry, you still can't deduct them anymore. And you're not contributing money to these IRAs and 401k, so you don't have all those deductions. You've killed them all. And now, even if you have less income, you're paying as much or more in tax. In fact, the average school teacher pays back every 2.5 years, every dime in taxes they saved over 30 years on the seed money. The first 2.5 years of retirement, they pay back every dime they saved in tax over 30 years of the contributions. And they keep doing it again every 2.5 years. If you live 20 years after retiring as a school teacher, you take 2.5 into 20, and you're going to be paying back at least 8 times the taxes. Many times you live 25 years. You can't believe how many people pay 8, 12, 15 times the taxes back that they saved on all the years they contributed money, and they just do it again and again. The longer you live, the more you're going to pay. Isn't that sad? Most people don't think about that. So the second biggest expense that erodes away people's purchasing power is the taxes that they pay on the money that they are withdrawing out of their IRAs and 401ks. It's also the medical costs. Those are the two biggies. Now there's other expenses, but you can't believe how many people, they sort of see their nest egg. Ooh, we got $1 million account over here. It's tax-deferred IRA. What used to be our 401k, but we rolled it over to continue to save tax. Oh, really? $1 million. I don't care if you were earning 10%. You pull out $100,000, and they see that they are only netting $70,000 after tax, and then they have all their health care costs that gobble up another 20 or 30,000 a year that they didn't see coming. You're pulling out 100,000 and only netting 30 or 40,000 to live on. But do you know the sad reality? Most people aren't earning 10%. The average person with money in an IRA or 401k in the market is only earning 3.5%. This is what precipitated the 4% rule in the financial services industry. That means you can only pull out 4%. If you pull out more than that, you have to sign a waiver that you will not sue your advisor for running out of money, outliving your money. So I started out this episode talking about how to cure or prevent the tax dis-ease. When our bodies are not at ease at a cellular level, that's called dis-ease, disease. Well, I've helped thousands of people cure their tax dis-ease because in retirement, they were totally not at ease. They were stressed out because of the amount of taxes that were eroding away. It's like a cancer in their accounts. And so we had to cure that. Now, many of them said, oh, I wish I would have met you 30 years ago and prevented it. Yeah, so do I. But that time has passed, and so we had to cure the tax dis-ease, and I usually would do that by getting the money out of their IRAs or 401ks sooner than later, get the taxes over and done with in today's lower rates, and then reposition the money. Even if they didn't need the money, I said, get it out, get the taxes over with. Reposition it into something that's going to be tax-free from now on, and when you ultimately pass away, that money will blossom, double, triple, or more, and transfer income tax-free. By the way, it will reimburse you any taxes you paid. How do you do that? In a laser fund. I want you to click on this episode and watch that, and then I would invite you to take advantage of the offer in this episode to get a free copy of my most recent best-selling book. It's called The Laser Fund. It's actually 2 books in one. One is comprised of 12 chapters with 62 stories. This one is all the charts and graphs and explanations. Most people like to read both. I would love to send one out to you free. You just pay $5.95 shipping and handling, and you'll get all kinds of epiphanies on why this is so much better, and it will cure your tax dis-ease also.